Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. It's Keith. Welcome to Monday, August 17th, middle of August, typically when financial markets slow down for vacation time, back to school, back to college this year. Obviously, a lot has changed. A lot's different. Mid-August is not the same as in previous years, but nevertheless, we are seeing a slowdown in volume like we usually do. Friday, 3.4 billion shares traded hands on the New York Stock Exchange. That was the lightest day since last year, so we are seeing some slowdown here in the summer. Hopefully people are taking a breather, reassessing, getting some personal time, focusing on what's important to them. So we're going to get started this morning. Here's what we're going to do. Going to start out with some quotes and some thoughts from over 2,000 years ago and talk about how they apply to today. Then going to turn it over and talk about what's going on this morning. Talk a little bit about what Barron's had to say over the weekend, and then turn things over to Brad Harris, Director of Fixed Income, to talk some more about the bond markets this morning. So to get started this morning, over the weekend I was reading some articles and quotes from a philosopher who lived 2,350 years ago, Aristotle. And what Aristotle had to say 2,350 years ago is just as relevant as it was then it is today, which to me speaks to how, as much as we think things have changed and we've made tremendous progress and we have made great technological leaps, nevertheless, humanity has not changed as much in 2,350 years as we often think. And we often, especially in these times of pandemic, it's a good reminder, need to be humbled to remember that we stand on the shoulders of previous giants, and where we are today is a reflection from where we've come. And previous civilizations and generations have still a lot to offer us and remind us of things that we can learn. So, some thoughts from Aristotle this morning through some quotes, talking about things in a political climate. Some political quotes that Aristotle has said. Some have even become so ingrained in our culture that perhaps we think of them as coming from our generation. So some thoughts here. He who has never learned to obey cannot be a good commander. He is to be a good ruler, must have first been ruled. A friend to all is a friend to none. Man is by nature a political animal. Man is a goal-seeking animal. His life only has meaning if he is reaching out and striving for his goals. And here's one that you may have heard after World War II. It is not enough to win a war. It is more important to organize the peace. All of these coming from Aristotle. Some on self-awareness and on self-actualization. Criticism is something we can avoid easily by saying nothing, doing nothing, and being nothing. Dignity does not consist in possessing honor, but in deserving them. It is the mark of an educated mind to be able to entertain a thought without accepting it. I count him braver who overcomes his desires than him who conquers his enemies, for the hardest victory is over self. Some further thoughts from Aristotle on education. Educating the mind without educating the heart is no education at all. Equality consists in the same treatment of similar persons. The educated differ from the uneducated as much as the living from the dead. Here's one on investing. The aim of the wise is not to secure pleasure but to avoid pain. Something that many of us often do when we invest is to cut off the pain and not necessarily really be able to focus on exactly what we're doing because the pain is so great. Some thoughts on habit and how we can live our lives perhaps better. We are what we repeatedly do. Excellence, then, is not an act but a habit. Excellence is never an accident. It is always the result of high intention, sincere effort, and intelligent execution. It represents the wise choice of many alternatives. Choice, not chance, determines your destiny. And finally, something that probably most clearly delineates the fact that not much has changed in the last 23 plus 100 years. Teenagers these days are out of control. They eat like pigs, they are disrespectful of adults, they interrupt and contradict their parents, and they terrorize their teachers. 2,350 years ago, Aristotle. So, getting started this morning, we are seeing futures slightly higher. Dow futures right now are indicating a implied open now of just about 9 points off from earlier highs. S&P futures looking up about 6 points. NASDAQ futures up about 60 points. So NASDAQ once again looks like it's leading the way. Global stocks edged higher this morning after the U.S. and China decided to delay trade talks. U.S. and China delaying their planned talks on reviewing the Phase 1 trade agreement. Over the weekend, President Trump gave TikTok owner ByteDance 90 days to sell the video-sharing app, and when asked whether he would seek to ban other Chinese companies, including Alibaba, he replied, "Well, we're looking at other things, yes." The Shanghai market was up 2.3% after the People's Bank of China injected financial funds into the system, providing more liquidity. Hang Seng was up 0.7%. The Nikkei slipped 0.8%. Japan reported a 7.8% drop in GDP in the second quarter, a record decline, but better than industrialized rivals, including the U.S. and Germany. The stocks, European markets are up on average about 0.2%. Taking a look at commodities this morning, oil relatively flat, down 11 cents. Gold is up about $19 an ounce. The big riser this morning is silver, up to over $27 an ounce, up $1.28, 4.9%. Taking a look at some other news this morning, we are seeing that Sanofi is buying another U.S. biotech firm, $3.7 billion deal, buying Principia Biopharma. Stock being bought out at around $100 a share. It was trading at around $90 on Friday, so about a 10% premium. Sanofi has been acquisitive. This week, today, the Democrats kick off their virtual convention with a show of unity for candidate Biden. It is a 4-day virtual convention being marked with speaking by a Republican, John Kasich of Ohio. Also this morning, we had news of another bankruptcy in the shale drilling space here in the United States. Chaparral Energy filed for bankruptcy protection over the weekend. On Friday, we got disclosures from hedge funds and big investors of what they had done in the previous quarter. Most notable, perhaps, was Berkshire Hathaway saying on Friday, saying it had sold shares in some of its largest U.S. banks, slashing its stakes in Wells Fargo and J.P. Morgan, and exiting its investment in Goldman Sachs. We will talk a little bit more about Goldman Sachs when we talk about Barron's. In a regulatory filing, as of June 30th, Berkshire also disclosed a new $20.9 million share investment worth a little over $550 million at the time in Barrick Gold, one of the world's largest mining companies. So Warren Buffett entering the precious metal space. IBM in the news this morning. They announced a new processor chip for data centers that it says will be able to handle 3 times the workload of its predecessor. The IBM-designed Power 10 chip will be manufactured by Samsung and is meant for use by businesses inside data centers. The chip will use Samsung's 7-nanometer chip manufacturing process, which is similar to the 7-nanometer technology used by Advanced Micro Devices and that is made by Taiwan Semiconductor. IBM said the new chip will be designed to be faster than its previous chip, up to 20 times the speed of its predecessor there. Also in the news this morning, Home Depot, and reports that traffic at Home Depot are up about 35%. at their stores. So, moving on to some other news. This morning we have an election coming up, and over the weekend, Wall Street Journal talking about the price to hedge or buy futures around Election Day, and Journal pointing out that the uncertainty this year is significantly greater than at any point in the last 20 years, where they have data going back on futures pricing. So if you look at futures pricing to hedge risk around election time this year, it's about twice the cost in 2016, about 40% more expensive than in 2012. It's about 8 times more expensive than in 2008, and about 6 times more expensive than in 2004. So certainly lots of desire to hedge and lots of expense around hedging for election time. Also, interesting piece on the cost of mining 1 ounce of gold. The cost of mining gold from about 1985 to 2005 for 20 years was somewhere in the neighborhood of about $250 an ounce. And recently, starting in about 2011, that cost has increased significantly, perhaps one of the reasons that gold prices have moved higher. And we're seeing gold mining costs now, since then, in the neighborhood of $550 to $600 an ounce to mine that gold. Therefore, the break-even price on gold is moving higher. Moving on to Barron's. Barron's talking about the overall markets, expressing some concerns about the recent uptick in equity prices, despite the disconnect, perhaps, between Wall Street and Main Street. So talking about that, last week the stock market had another good week. The S&P 500 finished up 0.6%. It's at 3373. The Dow was up just about 500 points, just under 28,000, and the Nasdaq was up 0.1%. S&P 500 gain was good enough for the index to finish the week within 0.4% of its February 19th high. So in other words, if you went to sleep on February 19th, woke up on August 14th, you would have thought that nothing, in fact, had happened. Assuming that the S&P 500 does trade at a new high, it would be the fastest recovery from a bear market on record. And it wouldn't even matter if the S&P 500 took its time, because the previous record was 310 days, and that was back in 1966 and 1967. So it's got plenty of time still to try and make up to achieve that peak from its trough. And Barron's is expressing some concern with the rapidity of the recovery, especially as we are still in the throes of the effects of the pandemic. So Barron's, in a separate article entitled "It's Time to Build Cash to Take Advantage of Stocks Coming Tumble," Barron's saying that the disparity between the equity market and the real economy, which is struggling to cope with the coronavirus pandemic, remains stark. As another measure of how far we've come, Thursday marked the 100th day since the S&P 500's low of March 23rd. That was written by the chief market strategist at LPL, Ryan Detrick. The 50+% rebound marks the best 100-day for the big cap benchmark. That's taken place while millions of people have lost their lives, and millions of people have lost their jobs. In the past, large 100-day rallies usually were followed by continued gains. In fact, when you had 100-day rallies like we just experienced, 17 out of the last 18 instances when we've had significant rallies over 100 days, we've seen the S&P higher over the next year. But Barron's is concerned that those dangerous words, that this time may be different. They are concerned about sentiment, with small investors piling in, and that indicating that we are with some froth here. Also concerned about the disconnect between the stock market and the underlying fundamentals, arguing that that disparity is the greatest in the past 30 years. S&P 500 valuation is at 26 times expected earnings, at the same time that the economy confronts the danger of a relapse, which makes for significant headwinds to the stock market, and that's not even considering, as we just talked about, the political season ahead, which may invoke some more nastiness between the incumbent president and the Democratic challenger. all this uncertainty taking place as there is lots of wrangling over relief for households, the next stimulus package, questions on whether or not the post office will get funding and whether we'll be able to have mail-in ballots, perhaps calling into question validity of elections as additional risk factors. I thought this was a poignant point made in the article. And this point is the key question for you as an investor to ask yourself is how would you react in the event of a typical 10 to 15% correction? Such a setback would be far from surprising given the current state of the market and the underlying fundamentals. It wouldn't even necessarily be the start of a new bear market since we're talking 10 to 15%, not 20. So the question is if you are prepared to invest more money in a downturn, then perhaps you're appropriately invested. But if the market were to decline 10 to 15% and you were not willing to put more money to work, then perhaps you own more stocks than you should given your true investing comfort. I'm going to move on and talk about two different brokerage firms that Barron spoke about. And they are on complete opposite ends of the spectrum as most people, at least the spectrum that most people equate them with. Perhaps the spectrum is converging, and these two companies are moving closer together. But nevertheless, interesting difference here, a dichotomy. We'll put these two up against one another. So Barron's headline story was on Robinhood, which has seen tremendous success as people have been stuck at home and have been trading stocks online at home. Of the roughly 6 million online trading accounts in the first 6 months of the year, 3 million were at Robinhood. In June, Robinhood processed 4.3 million transactions a day, more than any other broker and nearly 4 times as many as rival E-Trade. The lure of free trading and an easy, fun interface has drawn new investors to the platform. Barron's pointing out that critics say the platform motivates users to take on too much risk, comparing it to video games or online gambling. Even users who like the platform told Barron's that they worry it may be encouraging poor investing behavior. Executives at Robinhood responded to Barron's that they are increasing education awareness, they are improving customer service to help users, and they say it's not their role to tell people how to trade. If you're new to Robinhood or haven't seen it, the first thing you need to know is how different its app is from most brokerage sites. Forget about clunky mobile services that feel as if they were pasted from a desktop interface. Robinhood has removed the friction from the process. There are no account minimums, there are no bulky interfaces, and there are no delays for things like trade settlement. And these are things that could potentially discourage new users. The account approval process at Robinhood, Barron says, is remarkably fast. People can start trading even before money comes in from their bank accounts. Controversially, perhaps getting approval to buy complex products like options can be a simple process. It takes 10 minutes for users to check boxes certifying that they know what they're doing and have enough cash on hand, among other things. Trading is simple and visually compelling. Digital confetti is released for first-time traders. Users scratch their screens, not unlike what you might do for a lottery ticket, to choose a free stock to get started. Options trading, which I had mentioned, the approval process is amongst the easiest in the industry. Is something that has been taking off at Robinhood, and as well as with investors who have been staying home. June's option volume in the overall market is 81% above a year earlier. That's a staggering number. Options activity up 81% to a monthly record. And this is causing some consternation or concern among those who understand investing and the complexities of investing in complex products like options, because at a place like Robinhood, it is very difficult to get customer service. They do not have phone support. They are planning to reach out to customers proactively, a spokesman for Robinhood said, but they are not planning on adding a customer support line. How does Robinhood make its money? Well, they depend much more heavily on trading for revenue than its peers. They get paid for order flow, and that is money that Robinhood gets paid back from market makers in order to execute trades for its customers. Robinhood receives about half of its revenue currently from payment for order flow. To put that in perspective, at Schwab, payment for order flow accounts for just 2% of revenue. Here at Lanton Investments, we do not get paid for our order flow, so it represents 0% of our revenue. The market makers that receive the order flow from Robinhood, why do they want it? Well, they profit off the spread between the bid and ask price of the asset, and they pay a portion of that back to the brokers. Options, which are less liquid, tend to carry higher spreads and thus result in better profits for the brokers and market makers, perhaps creating an incentive for Robinhood to be more proactively suggesting that their clients take a look at options as they get a greater percentage of their revenues from an options trade than they do from a stock trade in terms of order flow. While receiving payment for order flow is certainly within the bounds and is legal, nevertheless, some in Congress are suggesting that this be more heavily looked into, as they're suggesting that perhaps payment for order flow rules need to be modified. Perhaps is not as ethical as it is. It certainly is legal. Robinhood, when asked about this, said we take our responsibility seriously, continually strive to improve and enhance our customer experience. And they said over the past several weeks they've implemented changes and enhancements to our options offering, and we plan to keep making refinements in areas like eligibility, customer experience, and education. So there we have Robinhood going more aggressively into the retail space and doing it from the trading and activity side. And then on the flip side, separate article in Barron's talking about Goldman Sachs and how they want to manage money for the affluent, and the affluent being described as the mass affluent. Mass affluent are those with more than $1 million in investable assets. Goldman has traditionally focused on the ultra high net worth customer, those with more than $25 million in assets. They've been making their way downstream and have now received about 7% of the market of the investors with a ultra high net worth portfolio, and they are now partly through their purchase of United Capital looking to capture assets from those with $1 million or more in investable assets. Barron's interviewed Tucker York, Goldman's head of global wealth management, who's been with the bank for 30 years, and he gave some of his thoughts on their initiatives as well as his thoughts on the market. When asked what Goldman Sachs' clients are most concerned about now, he responded, "There's a long list. Clients turning on the news, and they see that the news is not equating with the market being at or near all-time highs. Talking about the coronavirus pandemic, deep-seated social issues, trade wars, as well as the caustic political discourse and concerns about the economy, all coming to mind when thinking about what is worrying clients." When asked about what clients were doing in March and what type of conversations Goldman Sachs was having with their clients, he responded, there was way more conversation than there was activity, meaning that by and large investors were staying the course and were not radically changing their portfolios. When asked, what is the advice you've given your clients with a time horizon that is longer than quarter to quarter, he said, the advice we have given for multiple years that has been, in spite of the 10-year plus bull market, that people stay invested in equities. The risk of being out of the market outweighs the risk of staying in the market. It's very expensive to be out of the markets, especially if you're a U.S. taxpayer. Getting out means you have to pay tax, and then the hardest part, figuring out when to get back in. I'm going to mention one stock, then discuss the bond market a little bit before turning it over to Brad to give us some more insights on fixed income. Barron's stock pick of the week was Merck, symbol Mary Roger King. Barron's positive on Merck. Also of note this week, Value Line upgraded Merck to 1, their most timely rating. So two sources speaking highly of Merck at this time. Merck has the leading drug that harnesses the immune system to fight cancer. That is Keytruda. Also one of the top vaccine franchises. Barron's suggesting that Wall Street has perhaps overly worried about a 2028 expiration on that drug, Keytruda. That's the patent expiration. And investors have not been focusing enough, perhaps, on its new pipeline of drugs that could potentially replace or help complement some of the other offerings that Merck has. Again, 2028, which is 8 years out. Merck's stock price trading for around 15 times 2020 earnings, the middle of the pack for its peers, cheaper than the overall stock market, and the stock yields just under 3% dividend yield. Merck is also developing an antiviral for COVID patients that will compete against Gilead's remdesivir. The benefit of Merck's drug, if and when it comes to market, is it will be oral delivery versus a hospital infusion. Moving on to the bond market. Barron's talking about the fact that municipal investors or bond investors have been pouring money into municipal bond funds after pulling out records amounts in March and early April. And since the end of April, investors have put about $28 billion back into muni funds. That's about 60% of what they pulled out during the pandemic. So money is coming back strongly into the municipal market. In this morning's Bloomberg piece, there was a conversation with Vanguard's Paul Malloy, who oversees $224 billion in bonds at Vanguard, and he remains optimistic about the municipal market, saying that tax-free markets provide funding for essential services that are an absolute must for an economic recovery at the national level. States are very large employers as well, so Congress and others will have to act to keep from nullifying all the work that has been done this far, suggesting that the municipal market will not see significant bankruptcies. He doesn't say that you won't see a pickup in defaults, but what he does say is that in the high-yield and non-rated parts of the market, he does expect to see more defaults, but he says this would not be emblematic of the broader investment-grade market, which is still of very high quality, and where he does not expect to see those defaults as a result of the fact that that would be devastating for the general economy. All these municipalities and localities, one by one, really are the little lights that make up the big picture here of the United States. So letting those little lights go out, in his opinion, is something that just would not be conducive to a recovery, and therefore the assistance that they require at some point will have to be delivered, in his opinion. This morning, the Goldman Sachs has lifted its S&P 500 price target for the year, raising their target on the S&P 500 by 20% from 3,000 to 3,600. And their strategist, led by David Kostin at Goldman, expects the yield on the 10-year Treasury to rise from 0.7% now to 1.1% by year-end. So that would be an interesting development as well. Turn it over to Brad to give us some more insights into that and get his 2 cents on that and everything else. Good morning, Brad.
Good morning. Hope everyone had a good weekend, and just want to talk a little bit about the markets. The markets, I've been in the business 30 years, and I've watched all these cycles, and history just keeps repeating itself in the markets. I feel that we've gotten back to an uncomfortable place in the cycle where every product has experienced a major rally. Equities are at or near all-time highs, bond rates are near or at record lows, and it's really difficult here to handicap where the best place to be is going forward. Obviously, diversifying a portfolio always helps, but it's difficult when every product is moving in tandem as opposed to what we expect a portfolio to do in normal times when bonds are used to hedge equities and create income. And as we get to very low rates, that income keeps disappearing for new money. With all that being said, if you are an investor and looking to put money to work, municipals still seem to be the cheapest spread product out there on a relative basis. The 10-year Treasury is approximately 0.7%, the 20-year Treasury is approximately 1.2%, and the 30-year Treasury is approximately 1.4%. For municipal, a yield with the call of an 8 to 10 year call on a 20 to 30 year bond, you're looking at 1.75%. That's over 100 basis points better than the taxable treasury. You're getting a yield to maturity of close to 2.5%. This is by using a bond that is trading at a slight premium. So this scenario would be with a bond with a 3% coupon. You'd probably be paying around 110 cents on the dollar for it. That is the way that I would invest in the market here to get the pickup, as opposed to just going out to the 30-year horizon and look for 2% at par. This pickup is better. It'll protect you in a downtrend. So those who even want to be more conservative for that may want to look to buy a higher coupon bond, even higher than a 3%, with even a shorter call than 8 to 10 years. The shorter call, you're going to get less yield to the call, but by buying a shorter call bond, you shorten the duration of the investment. And what we mean by duration is that you will have a shorter time horizon to get your money back. The premium bond amortizes back down to par, which would be the call date. So if you have a 5-year call, your bond will be worth par in 5 years, but you could be carrying a 3.5% or 4% coupon, which may not be called, which at that point you're living with this 3.5% or 4% coupon for the rest of the life of the security, which is not a horrible way to play this market. I think it's worth paying the premium. I think it's worth accepting a little bit less yield up front to the call date, and I am definitely not super constructive on long-term par bonds at the moment. So I would stick with the premium bonds and give yourself a little bit of protection. And we will talk about what you do with those bonds at a later date. And last, I mention this all the time, but to beat a dead horse, quality, quality, quality. I know that Keith mentioned that there was a Bloomberg brief this morning with the gentleman from Vanguard who said that defaults in municipals will not be rampant. But the fact that we're even having that conversation is bothersome to me at all. There was an article in the Wall Street Journal. There's more and more talk about defaults. And yes, I don't think that the defaults will be rampant with the major issuers. They will be mostly in smaller, non-rated, riskier issues, nursing homes, things that they're really just pushing into the marketplace. And the larger states and cities should probably be okay. Obviously, keep an eye on the pension funding for cities like Chicago and other cities that are having financial trouble. As I've mentioned, if you were having financial trouble before this pandemic, you sure are having a lot more financial trouble now, and the government has basically said they're not bailing people out for their financial mismanagement. So this is absolutely a time. It's a quiet period. As Keith mentioned, it's a summer, August, and even though the news cycle is quick and vicious at times, it's a good time just to take some time, review your portfolios, continue to upgrade credit, take advantage of the uptick in the junk bond market to move out of some of your riskier credits, maybe look into a different product that you're comfortable with. But this is an opportunity because the municipal market is super frothy and it wants yield. So when the market wants yield, you give them yield and you upgrade your portfolio. Thank you.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.